It was nice hearing to several of the regulatory reforms that the other groups mentioned so far in the presentations. And we here are to discuss the impact of regulatory reforms on the functioning of financial markets and detailed debt market reforms, one with a positive impact and another with a negative impact. Broadly, the financial market comprises all the marketplaces where the trading of securities occur, including the stock market, the forex market, the bond market, derivative markets. Notably, these are impacted by the policy reforms in the overall financial sector. The stated objectives of the financial market regulations include increasing the stability of the system, protecting customers from fraud and malpractices, providing a level playing field to the traders with different stakes, enhancing transparency, etc. We have several regulatory agencies that try to regulate, that try to control the financial market. They do it by bringing in rules such as entry barriers, barring participation in high risk assets, compliance measures, etc. Basically, they try to control some of the factors such as liquidity in the market, level of safety available to the different stakeholders, including the investors as well as the creditors, improving competition and the efficiency of the system, etc. The rules apply not just to the companies and exchanges but also to the individual and institutional investors. If we try to see the track record over the decades, the regulatory agencies have opened up the Indian financial markets much more from the 1990s, allowing almost 100% FDI in most of the sectors and also opening routes for the FII. Almost all the processes in the trading system today are IT dependent. SEBI regularly comes up with new laws to improve transparency by increasing the disclosure requirements. However, it is not all roses when it comes to the impact of regulations. They come with several costs, both direct and indirect. It includes enforcement costs, which is a part of the regulatory burden, and the cost of compliance to the companies in maintaining records, audits, etc. Financial markets are distorted unfavorably, and and the uncertainty about the policies harm the ease of doing business. Further, more often than not, the regulations target decreasing risks, as we saw in most of the presentations today. And when you decrease risk, it actually also decreases the returns. Several investors feel worried about the uncertainties and they leave the market, thus increasing the cost of capital to the companies. And this led to overall fall in the economic prospects. We'll see more about this in the next slides. Over to Vinay for the structure of debt market in India.
So debt market is the market where fixed income securities of various types and features are issued and traded. Fixed income securities offer a predictable stream of payments by way of coupon and repayment of principal at the maturity of the instrument. Depending on the issuer of fixed income securities, it can be classified as government securities or corporate bonds. So corporate bonds are issued by private players or public corporations. Some of the instrument of debt market are zero coupon bond, commercial paper, certificate of deposit, T-bills, state development loans, etc. In India, debt market is dominated by government securities. The domestic debt market in India amounts to about 67% of GDP, while the size of India's corporate bond market is mere 16% of GDP. Also, the largest investor group in the GSEC market are the banks due to their regulatory requirement to invest in SLR. The Indian debt market is largely a wholesale market with a majority of institutional investors comprising of mainly banks, financial institutions, mutual funds, pension funds, insurance companies, and corporates. In developed countries like the US, primary source of finance for corporates is bond issuance. In India, historically, bank loans have been the primary source of funding. However, the share of corporate bond is increasing. For instance, the proportion of bond in total finance to corporates increased from 32% in FY13 to 43% in FY18. Corporate bonds have grown at a CAGR of more than 12% between 2013 to 2018. The debt market in India is regulated by RBI, SEBI, and Ministry of Corporate Affairs. RBI regulates the government securities and money market instrument, and SEBI regulates the bond market, while MCA regulates the non-listed securities. Now, Vibhor will discuss the impacts of regulatory reforms on the debt markets.
I'll walk you all through one of the most prominent regulatory changes that brought in positive impact in the Indian debt market. That is enactment of IBC, Insolvency and Bankruptcy Code, which came into effect from 1st of December 2016. Before it, the resolutions were done through SICA Act. IBC is applicable to companies, LLP, partnership firms, and individuals. The bankruptcy code is a one-stop solution for resolving insolvencies, which previously was a long process that did not offer an economically viable arrangement. The average resolution time in 2015, as shown in the bar chart in the left side of the slide, in India was 4.3 years, whereas the same was 1.5 years in USA and only 1 year in UK. The resolution time in India was high because a lot of time was taken in court cases resolution and lack of clarity in the prevalent bankruptcy framework. IBC has brought this time significantly down as it is a time-bound process. So it has been observed in many countries that 5 years after the bankruptcy reforms, the corporate bonds to GDP ratio almost doubles. Some of the companies from which debt was recovered through IBC are Essar Steel, Bhushan Steel, and Amtech Auto. So this slide shows various figures related to Indian corporate bond market. We can see from the top two charts that number of issues have increased by 9%, but the total value of those issues have increased by approximately 61% between March 2016 to March 2020. This shows the increased confidence and trust of investors in Indian debt market. From the bottom two charts, we can find that number of trades has increased by about 38% and traded value has increased by 66% between the same period. This shows that the liquidity has also increased in the Indian debt market. This slide shows the various institutions that were created for the resolution purpose and how the resolution takes place. IBC created a specialized cadre of licensed professionals who administer the resolution process, manages the asset of the debtor, and provide info for creditors to assist them in decision making. The insolvency professional agencies conduct exams to certify the insolvency professionals. The creditors communicates to information utilities about the debt owed to them by the debtors. The proceedings of the resolution process is adjudicated by NCLT for companies and DRT for individuals. Insolvency and Bankruptcy Board regulates the insolvency professionals, insolvency professional agencies, and information utilities. The resolution consists of three basic steps as shown in the bottom of the slide. They are initiation, decision to resolve insolvency, and the last one is liquidation. And now Akshay will take over.
One of the regulations which indirectly had negative impact on debt market was 2009 International Basel III Regulatory Accord for banks. Because it is an iterative process and has not been fully implemented globally, we specifically look at US context during the period 2010 to 2016. So Basel III had three main pillars, two of them which affected financial market are shown here. First is capital ratios and targets. To comply with regulations, banks were required to hold a leverage ratio which is Tier 1 capital divided by average total assets in excess of 3%. Also, minimum capital requirements of banks was increased from 2% of risk-weighted assets to 4.5% in Basel III. There is also an additional counter-cyclical buffer of 2.5% capital requirement that brings the total minimum requirement to 7%. Second pillar was liquidity requirement, which required banks to maintain liquid coverage ratio that is held sufficient highly liquid assets compared to the net cash outflows to withstand a 30-day stress funding scenario. Also, they had to maintain a stable funding ratio above the required amount of stable funding for a period of 1 year. Summarizing this Basel III, it was introduced to improve banks' ability to handle shocks from financial stress and to strengthen their transparency and disclosure. Although the regulation was for banks, it had impact of it had spilled onto debt markets. One of the major impact was decreased liquidity due to increased capital requirements of the banks, which act as a primary dealer to dedicate capital to investors. Also, bid-ask spread widened to a small extent, indicating lower liquidity in the market. So borrowing cost of the investors also increased because of the lower activity in repo financing and also restrictions in warehousing and market making. These three graphs were taken as a proxy for measuring liquidity in the debt market, and we can see from this that there's a significant decline in liquidity in the US fixed income markets, though not structural but short term, as market responded with several innovations to counter the regulations. So summing up, there are both positive and negative sides of financial regulations on debt market, and can say post-truth is easier to formulate. Thank you.